Welcome, Perennial Pride listeners. Super excited for this episode today. This is part 2 of how to use your family bank throughout life. And if you haven't listened to the first podcast, I'd really encourage you to go back and listen to that, the earlier stages of life. I broke them up into quarters, just to simplify them into 4 quarters of our lives. And obviously, if you're fortunate enough to start a family bank early in life, hopefully by this stage of the second half of life, the game of life, that you'll be in a pretty good position here. And so I would really hope that you go back and listen to the first one, though, to give you a grounding and give you a sense of where we came from. But on this one, we're going to be talking about ages probably in the range of 40s to 60s, right? That sort of big chunk of time where you're really building and probably in your careers or your business, and really some of the peak earning years, and then segue into the last quarter of our lives of transition. And some people will call it retirement. I like to use transition into something potentially else that you want to get into, that you feel compelled to do and impact the world, and transition there, and then how the family banking environment can really help support that. And then obviously thinking about legacy planning. And for those who have adopted the family banking concept, they are thinking long term. So thinking about the next generations and even farther down the line of grandkids, their kids, etc. And we'll get into that as part of this episode. So here we are now sitting in, hopefully we've had a family bank open for quite some time. It's starting to gain some momentum. As you recall, early in the stages of family bank, just like you're building a business, you got to capitalize it. You got to get it going. And early stages are the hardest part as you're building up and the cash is growing and your death benefit is also growing, but it takes some momentum. And that's the discipline that we need to have as it relates to this sort of strategy and approach. But as you're going to get so many benefits along the way and further down the line if you can stick with it. So here we are, 40, say 41 to 60-ish. Obviously, it's going to vary for people, but here we are growing in our income and our jobs, right? Or the business is gaining some momentum and income and value. So we're having to maybe have more asset to deal with, to manage. And our kids are growing, potentially if you have a family, and you have kids who are also going to need more as they get older too, around education and help potentially if you want to help fund those sorts of things. So that's certainly a part of the challenge. But as it relates to first going back to hopefully income's growing. So in this area, you may have run into an issue where your family bank doesn't have a lot of room left into it because it's being filled with more cash along the way as you start adopting this strategy. So there are cases where that's why we have term insurance along the way, not only for obviously protection early on as our kids are younger, we have a mortgage, whatever, to have those protections in place. But here you now need to start adding to your family bank using the term conversion option in these policies that are guaranteed, even if your health changes. So it'll utilize the health rating that you got initially when you took out these term policies back in the day, when you're hopefully healthier, younger, and fitter. Obviously, you're going to be funding them at the higher cost based on your age at the time, but it will use the health rating as based on what you got early on when you got the term policy in place. And most people are not thinking about this too far in advance because they assume nothing's going to happen to them, health is going to be good. But as we know full well, life changes, and I've run across a number of people where in their 40s that they're no longer eligible to get permanent policies because of their health, had a stroke or whatever the situation is, and they're no longer insurable. So it does happen. That's why it's so great to get it early when it's cheaper and it gives you the option down the road. So this is where you could be adding to your bank, but you may not especially if you have some larger expenses coming up, like paying for college. You may want to use some of the funds you've built up in the life insurance policies to fund college. And usually the trick with this is that you can this is the flexibility of these designs, is that you can slow down the contributions to them, take some loans against your cash to help fund for college, and then continue to pay into the policies pay the loan back through your policy. And this is where you can control that, hopefully get into a rhythm to do it monthly, just out of regularity. but you can pause if something unique happens. But you can use, again, this is where the power of the financing arm of these sorts of policies can really come play a big role, because you can borrow against it, use it to fund college, pay it back on your flow of payments, and contribute when you can. And so this really, and while your cash value in its entirety is still working in the background, growing and compounding tax free and all the good parts of that because you're not actually touching those dollars. Just as a reminder, like if you had money sitting in the bank, you yank that money out of the bank, or say in a lot of cases, people are using, say, a 529 plan, you use that money and you basically have to remove it to pay for things. And then those dollars stop working literally for the rest of your life. And so this is why we use this approach to allow our assets to continue to grow and compound and starting to gain momentum, and then borrow someone else's money to finance things in our lives. So hopefully that makes sense. And certainly it is a little slightly different than, maybe some of the different approaches, but this is how we can strategically use and leverage our assets instead of just spending them. Now, obviously, during this time too, as your income and your assets are growing, you might need to add some more protection in place as your incomes, because your human life value is continuing to grow. Hopefully that's the hope. And so you may want to get some more term insurance, because as you're building this family banking environment, you might want to add more even further down the line when you get into your later stages of life, and you potentially have less. And we'll get into that a bit more. And certainly during this time, you may be considering, as you move into later stages of life, long-term care. We're living longer. That's a good thing. And but what comes with that are other risks that we may not face when we're younger, like long-term care. And for some people, this will make sense. And this is where you can add to your family bank certain provisions that allow you to leverage your death benefit for long-term care purposes if needed. And if you don't need it, then you can use it for a death benefit for your legacy planning. So it's really something to consider. It is not for everyone in every situation, but it comes up in this environment here, and you can leverage a family banking sort of structure and still have some assets and death benefit set aside to potentially cover long-term care if needed. And so, and hopefully during this time, obviously we have the potential expenditures that may come through this time of our lives, but it's also hopefully we're still continuing to build assets. And this is the beauty of the family banking environment, to again leverage the cash value as a collateral to borrow against from the life insurance company. In some cases, you can even use the bank. Bank will use it as collateral to help finance investments in things that you can own and control, and you have more education and experience with, whether it be real estate, businesses, natural oil, natural gas, oil, whatever, stocks even. And so these are all options, and you just have to be selective where you're putting it. I prefer that the investments that you're putting in bring back cash flow to help fund the financing arm as you're taking out loans for this. So that's why, whether it's real estate or even private lending, those are all different options to consider as you're expanding your breadth of knowledge of investment types. And consider that as you sort of start deploying assets here. And there might be ones that may be higher risk speculation. You wouldn't want to borrow against a policy to do that. It certainly adds an element of risk here that we may not want to take. But for ones that have more stable assets that are likely going to bring back cash flow, these are great options to utilize your family bank for. So that's I would say, quarter three. And it's I consider a build and growth mode, not build, but more growth mode. Build was kind of quarter two. You're really growing your assets. The policies that you're using in your family bank are getting very mature. And it's like you put $1 in, you're getting much more than $1 back in cash as it's getting mature in the stage of the policies. And again, you might want to start considering adding some as your human life value continues to grow. So now we're going to shift gears to quarter four. Now, quarter four, later stage in life, and again, arbitrarily selected greater than 60. It could be higher, lower, whatever. It's obviously unique to everyone. But just to simplify the conversation is, obviously this is an area where people are starting to maybe get towards the end of their careers, or thinking about maybe transitioning, slowing down a bit. I'm not a big fan of the word retirement in itself, but you may want to just retire completely and take some time off. And that's all well and good. And that's a choice you get to make. or maybe transition to another career or a passion project, whatever it is. But obviously, you may be considering sort of slowing down the work that you do on a daily basis and how you're impacting the world. And so this is where you'll have some options because the policies that you own in your family bank are now even more mature, right? We're getting towards that the really maximum value these things are starting to build towards, and you'll have some flexibility to maybe stop funding if you want to. Now, if you ever looked at the policies, you're going to see that it's becoming very efficient and a good place to store cash, and it's going to increase the cash value in here and death benefit as well. So you'll have some choices to make around there, how much you want to continue to contribute. But when you kind of see how much it's growing each time you contribute, you may want to, but you can slow it down quite a bit if you'd like to, and basically even shut it off at some point, just given the nature of how mature they are. You could stop contributions. You can start using the dividends that you get from the policies to fund the contributions. So there's going to be a lot of flexibility in here as you migrate towards the later stages in life. And so, one of the things that's often comes up and in the typical financial world is buy term insurance and never have this sort of policy in place in retirement, and because you don't need it. Now, I would agree with that assessment that you do not need it. If you understand how it can really add to your other assets, you may want it. And there's a host of ways. I'll go through just some examples of them, and I'll probably do a separate podcast on this to just how do you use your death benefit in retirement or in later stages of life before you die. So use your death benefit before you die. So there's a host of ways, but so here, for example, we're going to go through a few different things here. One, not so much the death benefit in this first example. It gets into how to create income in retirement, and so you could do a few things with this your family bank. If you have different options here, different policies that you've built, you can use some to create streams of income. You can annuitize. Have you ever heard the word annuity? And it may have a negative connotation to it, but it creates a steady stream of income that's going to come to you like a paycheck. So you can annuitize your cash value and basically remove the death benefit if it's not something you want. You can create a annuity and get a stream of income, right? And some of it will be taxable based on the gain, but everything you've contributed will not be taxable. Could use that. The other option is this is where it's a the cash value life insurance. It can really be a good complement to your investments. So say you had like a 401k or a brokerage account, and you might be pulling money from there. Well, at times when there are fluctuations, volatility in the markets, like we're seeing these days, it's probably not a great time to start pulling money out of there unless you have to through required minimum distributions. But here you can strategically choose when to take it out of there and use an uncorrelated asset like cash value life insurance that has tremendous benefits. And you can pull that out and use it tax-free income and use that in the case of the years when the market goes down, and let that regroup instead of using and adding more losses to it. Let that sort of regrow and recoup, and then use another source of money from what we call a volatility buffer of a cash value life insurance policy. And that's proven to help really allow your other assets, your investment assets, to last longer and use them more over time. Another thing, which I don't, for a lot of people these days, pensions are not really a tool or asset that people have in retirement. If you work for a government or some other entity like that, as a teacher, you might, but for most people, you won't have it. But if you do have it, you can leverage the life insurance policy to maximize your pension. So imagine a scenario where you had an option in your pension to take the most amount of money, or take a lower amount. And then if you died, then your spouse would get that amount going forward until your spouse passes. Well, that's really insurance built into those options there. But here you have it in place already through a family bank environment or a life insurance policy. You take the maximum in your pension, maximum amount, and then once you pass, your life insurance will help refund that for your spouse and then for your loved ones down the road, so you can maximize the pension in that way. And lastly, which I think is probably for most people, a lot of folks in this world are going to have if they're fortunate enough to own a home and hopefully they paid it off and there's no more debt, it's going to be one of their biggest assets. And We've seen home prices continue to rise. It's been a little bit crazy lately, but over historically it has grown. And because you're using leverage to your house, it's going to grow, by an even larger multiple, but it's still good. It's still good to have. And but the problem is, how do you create income from it? And one option other than selling it and moving on is to, if you want to stay in the home, use a reverse mortgage. And there's obviously a lot of negative stuff on that. We'll touch on that another day, but it can be a very powerful tool to create some tax-free income and then have the death benefit give the remaining beneficiaries after you pass options to pay off the reverse mortgage or let the banks take it and you just take the death benefit. So it's another way to unblock the value out of the home and get some income streams that are tax-free. And then you don't disinherit family members or put people at risk. So this is why the complementary working with different assets together can really make them much more valuable than if they were just independent. And so that's just another option. And so the last thing I want to touch on as it relates to the family banking at the sort of tail end of, the later stage, the quarter four of our lives, is to consider the legacy planning. Obviously, we know life insurance and it has a tax-free death benefit, so that can be passed. And depending if you have estate tax issues, which some people are, and that can change, right, with laws and reduce the exemption. So if you have an estate tax issue, there are ways to ensure that your life insurance policies can pass without being part of your estate, and that can go tax-free to your heirs. So that's a really huge benefit to passing on. And the other option to this too, as you're living this portion of your life, you may want to fund your policies for your grandkids. And this is sort of the continuation and the building of this generational wealth, because, here you are as a grandparent, potentially you have children who are maybe adults at this time and building their careers and building wealth. And so when they have their own kids and now you're a grandparent, that you can help fund, if for the grandchildren, start them in their family bank early on, policies for them. And so you have policies on the grandparents, the kids, and then the grandkids. And now you have a trio of generations. They're all protecting their human life value. And for the folks who are building this early in stages, and especially the grandchildren, putting policies on them when their health is best, we can start them early and have decades of growth of cash value that's protected from taxes and can grow and protects their human life value and helps build this chain of a family bank. And someone has to start this. And so for my family, just in transparency, that I've started this for myself, obviously my wife and I, but we put them on our kids and they're growing. And the plan is if they do have children someday, to put policies on them, on the grandkids. So then we can continue this legacy down the road for generations to come. So it's just something to consider. It's something that's important to you to build that legacy, but it also gives them a means to sustain a bank for more generations, but it also protects their lives. And we know that we're not guaranteed even tomorrow, but putting protections against our most valuable asset, which is us, is something that's part of this entire family banking sort of philosophy and strategy. So I know I threw a lot at you at this stage, and we'll probably do some other episodes on this, and we can go through some slides to kind of walk through some of the details of this. But if you want to hear more, learn more about how this could work, certainly reach out at tom@perennialpride.com for sure. Love to hear from you, ask questions, put some comments, and reach out if this is something that maybe is helpful for you and something that matters to you and something you want to explore further. So great. And we'll see you on the next episode of the Perennial Pride Podcast. Thank you for being with us here today on the Perennial Pride Podcast. It's an honor to be a small part of your journey to financial freedom. If you gained new insight on today's episode, please follow us on your favorite podcast app, such as Apple or Spotify, and follow us on our YouTube and Facebook pages. Also, we always love feedback on helping to improve what we're doing here, so please provide in comments and questions so we can make this podcast even more helpful for you.